Are you thinking of becoming financially independent one day? While that may be super scary considering you've been dependent on your job and your retirement contributions all your life, the upside, when done right, can be quite rewarding and life-changing. The actual thought of venturing into the world of managing your finances, investing and having total control of your financial future may seem overwhelming, especially if you are in so much debt, you don't have a lot of money saved, not good with handling money, and unsure exactly where to start, which sometimes is the biggest struggle for a lot of people. In this video, we will take a deep dive into the simple fundamentals of investing. Here are the key areas we will cover in this topic. Number 1, property investing. 2, equity investing. 3, cash. 4, loans or debt investing. And 5, important key terms. Let's quickly dive in. Number 1, property investing. Whether it is a piece of land, a house, an apartment building, commercial buildings like stores, office spaces, hotels, and the list goes on. This is a physical asset you can invest in, either by way of cash, debt investing, or equity investing. Unlike most other types of investing, the upside of property investing is that even if the investment strategy fails, there is still a physical asset you can sell to recoup all or some of your investment. Number 2, equity investing. If you are a fan of the TV show Shark Tank or Dragon's Den, you might have heard an entrepreneur pitch their business idea to the sharks or dragons that are potential investors. Whenever they invest in an entrepreneur's business, he or she may acquire a percentage of that business. For example, they may say, I will give you $200,000 in exchange for 25% of your business. That stake is also called equity. Equity investing means owning a piece of the company you've invested in. This form of investing is super risky as most businesses fail, but it also gives you the highest potential chance of reward, especially if the business you've invested in becomes the next big thing like Amazon, Facebook, Apple, Tesla, Uber, Airbnb, and others. While this example may seem too extreme as not everybody has the investment power of the sharks and dragons, there are simpler forms of investing where you can buy shares of businesses with a smaller amount in the stock market. There are online investment websites like Questrade, which is a self-directed investing platform that is easy to use. I will leave the link in the description area for anyone interested to learn more about this type of investing. Number 3, cash. This is essentially putting money in a bank account. It is super low risk, but you are also not going to make good returns on it. This is a low return investment for those that want a lot of safety in their investment. While this might not be the choice for a lot of people because they consider cash worthless, if not put to work, and also because of inflation, this can definitely be the choice for people who want peace of mind due to the ups and downs of investing. 4, loans or debt investing. A company or entrepreneur could use debt to provide money required to start or fund the business. Debt investing can come in several ways. It can come from investors or even from borrowing from financial institutions. The major key difference between debt and equity investing is that in debt investing or financing, you receive your loan amount with some interest, while in equity investing, you own a stake in the business. Number 5, important key terms to remember. A, ROI, return on investment. To calculate your return on investment, it's going to be net return on investment divided by cost of investment multiplied by 100% equals your ROI, or final value of investment minus initial value of investment divided by cost of investment multiplied by 100% equals your ROI. For example, if you invest $2,000 and make $2,500, your ROI will be net return on investment, which is 500, divided by cost of investment, which is 2,000, multiplied by 100% equals 0.25 or 25%, meaning you made 25% profit on your investment. B, value of a property. To understand the value of a property, we will take a look at these key areas: purchase price, rehabilitation or renovation if needed, worth of the property after appraisal, equity, and cash flow. Let's put a number to it. If you purchase a house for $300,000 and you renovate it with $20,000, and after appraisal, it is now worth $380,000. You rent it out, and after paying your mortgage fees and other fees, it cash flows $300 monthly. To calculate your equity on the property will be the new property worth minus purchase minus rehabilitation or renovation equals $60,000. In conclusion, everybody starts from somewhere. First, understand the risk level and your comfort zone. The first thing that holds people back is fear, while the other one that leads most people astray is greed. By making a conscious decision and choosing an investment strategy based on thorough research, continuous learning, and commitment for the long term will definitely yield results. Always remember, never invest in something you are unsure or know nothing about. Once you're ready to explore the investing world, decide how you want to approach it. You could either go the savings route or use your budget planner to include your investment savings goal. Check out my video in the description area on how to create a budget plan geared towards investment purposes. You can also explore the debt route to investing. A lot of entrepreneurs have created tremendous wealth by using debt to their advantage. While that may be a scary path to most people, it can also yield tremendous upside if you play it right. Thank you guys for watching, and bye for now.